Again. One of the things that hasn't changed in the past 5 years or 25 years is the importance of income tax on all corporate and commercial transactions, and particularly on buying and selling a business. I talked before about being a general practitioner and having to know a little bit about everything in the commercial law area in order to do a good job for a client when we're acting for them on buying and selling a business. And one of the things that I include in that is income tax law. Income tax law is hard for all of us, and there's a temptation sometimes to say, I don't need to know that stuff. I can let my client will have some sort of tax advisor, either another lawyer at my firm or another lawyer at a firm that specializes in tax law, or more likely his accountant who's giving him tax advice. So I can sort of fall asleep through this part of the seminar and I don't have to pay attention. But I found that to do a good job, the most important, you do have to understand enough of the tax so that you understand where the negotiation, what the issues are. And I found that it's not rocket science to be an expert at it. I think is rocket science, and I don't mean to suggest that any of us here in the room besides Professor Krishna are going to develop that kind of expertise, but I think it is worth the discipline that's required to develop a basic knowledge of the issues that come up in buying and selling a business, and understanding how they work, and being able to advise your client. We're I think fortunate to have Professor Krishna speaking to us today. If you look at his CV in the materials, as I do, it makes me feel like I haven't accomplished anything with my life to date, and he's accomplished so much. Among other things, he has degrees from Harvard and Cambridge. He's now the executive director of the CGA Tax Research Center at the University of Ottawa. Many of you have probably taken classes from Professor Krishna. He's the author of a number of texts, including the Essential Income Tax Law, and a text on Canada's tax treaty, and another text on international taxation. He's a fellow of the Royal Society of Canada, and in 1993 he was a recipient of the Governor General's 125th Canada Commemorative Medal. He was a few years ago a commissioner on the Ontario Securities Commission, and as I'm sure you all know, he was a bencher of the Law Society of Canada. We haven't heard the election results. Professor Krishna may know, but I don't think they've been publicly announced, and so we'll wait with bated breath to see, as I expect, whether he's been re-elected. Professor Krishna?
Thank you very much for that very generous introduction. Yes, with the support of those of you who voted for me, thank you. I was elected. The results are out. Thank you very much. I appreciate your support. For those of you who did not vote for me, perhaps you may consider it and reconsider next time. We'd appreciate your support then. Tax law is one of the most pervasive and exciting subjects in all of law. It is not commonly thought of in such terms, but it is truly in the practice of law and the teaching of law one of the most intellectually challenging, stimulating, and, as I say, pervasive subject matter. Most people ignore it. They ignore it simply because it is difficult, and we tend to ignore things that are difficult in the expectation that they'll go away. But you cannot escape it. You cannot escape it in any venture of life, from the minute that you get out of your bed in the morning till the day you go to your grave, and even thereafter. You will be affected by it, both personally, privately, professionally, and in your business life. My job today is to speak to you as general practitioners and not as specialists, to sensitize you and to raise your antenna to certain issues that are involved in the transaction of a purchase and sale of business. anytime you have a transaction in which money crosses hands, you have a tax implication. That is what lawyering is about. I was speaking to one of the Boston Brahmin lawyers a year or so ago, and I asked him what kind, this gentleman was about 83 years of age or so and still practicing, and I asked him, I said, what kind of law do you practice, sir? And he said, I practice transactions law. And I said, well, what is transactions law? I mean, I've never quite seen that in the areas of specialization that we have. And he said, well, I move money from one place to another or one person to another as a result of transactions, and in the process, some of it stays with me en route. That is transactions law. You facilitate transactions. That's your job. Now, it is to facilitate transactions, not to cause problems, but to see problems and see solutions around those problems. And anybody can see a problem. I mean, if you work for the government, that's what you specialize in, raising problems. The issue is, do you see the solution to the problem that you see? And that's the job that we play in this scheme of buying and selling businesses. We are not the prime movers in these transactions. There are basically three issues. If you're at tab 4, I've given you a fairly comprehensive set of materials. I'm going to speak to and around these materials, and you can use the materials in their detail if, as, and when the issues arise. But I want to explain to you the context so that you can go into the detail when the time is appropriate. And as I say at the outset, there are three decisions that you have to make. The first decision is not for the tax lawyer, or very rarely for the tax lawyer. There can be some very, very specialized decisions where the tax lawyer is actually making decision. One, namely, do we buy the business? That's a commercial decision. That's a commercial decision. It's a business decision. And the first point I want to make is that there is absolutely no difference in principle between a small business and a large business. Absolutely none whatsoever. So that the whole notion that you're acting for small businesses versus large businesses generates new law and new principles is a completely misguided concept. The only difference between acting for large and small businesses is the number of zeros that you put onto the end of your bill. But there is no difference in principle whatsoever. There's no doubt that large businesses have many more people working on the file for many more transactions, but for a person who loses everything in a transaction, whether that person has lost $5,000 or $100 million, it doesn't make any difference. It's 100% of what they've lost. So you cannot take, and the client will not take any comfort in the fact, oh, well, my loss was only 100% and I only had $5,000 or $100,000 and I lost it all. The other fellow is far worse off because he or she lost $100 million. That's not true. The decisions that we are concerned with is what do we buy and how much do we pay for it? And those two are interrelated decisions. They cannot be made independently. They're interrelated decisions because the price that you pay will be influenced by how you buy it. Or the other way around, how you buy will affect the price that you pay. And why? Well, quite simply, because those two questions answer the issue, how much money do I put in my pocket? And that's the only issue that the vendor is truly interested in. A vendor is not really interested in the gross selling price of the transaction. The vendor is only interested in the net amount that goes into his, her, or its pocket at the end of the transaction. And that's what we're all interested in life. All of us. I don't care what my gross pay is. It makes no difference to me. At the end of the day, I want to see what goes into the bank. And you can raise my gross pay 100 times and take away the same amount in taxes and leave me with the same amount in the bank. I haven't improved my position. And we all know that. And the business transaction is exactly the same way. Now, at the outset, first of all, let me refer you to the financial statements. You have a balance sheet and a statement of earnings. And right in the last page of your materials, or my material, and under tab 4, you have the very last page, 88, a comparison of assets versus shares sale transaction. It's a summary. And I want to take a top-down approach. I want to start with the broad overview and move down a little bit into the detail, but not into the excruciatingly difficult detail that will put you into a painless sleep. I just simply want you to understand conceptually what this whole thing is about, so that when you go and talk to your counsel or your accountant or whomever it is you choose to take your advice from, at least you will have some understanding of where the person is coming from and what the client is. When you have to explain it to the client as to what you're doing, you can do so in terms that the client will appreciate and understand. Now, the essential of this whole area lies in one simple concept, and that is, when you have a business, as you have those financial statements with assets and liabilities, we have a whole set of rules in the Income Tax Act that tell us what happens when you buy or sell or transact in any individual asset. You know that from your Tax 1 class, or what we call the baby tax class in law school, that if you go and buy an asset, sometimes you can depreciate it, sometimes you can write off the cost of the asset, and sometimes you cannot write, because the Act has a scheme in which different transactions and property are handled in different ways. We don't have to go into why for today's reasons as to whether that makes sense or doesn't make sense. The fact of the matter is, we are stuck with it. We are stuck with it. It's an excruciatingly complex and detailed set of rules that increases in complexity exponentially. And it increases exponentially simply because of the demands of society keep putting the pressure on for the complexity to increase. As you all know, if you're reading the paper now, with the Nortel statements and the high technology statements and the Ontario government statements and the BC government statements, they have said that they want to do something special for the high-tech sector. That's the most mindless and stupid proposal ever made, that you want to do something for the high-tech sector. Why? Because it will require a demarcation of lines, and we are talking about high-tech business right here, as to what is a high-tech sector. How do you define a high-tech sector? Every time you make a line, you have to define who comes on this side of the line and who comes on that side of the line. Is a person working in low-tech, for example, a highly qualified person working for DuPont, in the low-tech sector, whereas a person working for Newbridge in the high-tech sector, so we'll give the stock option exemption to Newbridge executives, but not to DuPont executives. Does that make any great sense in the long run? And how will you derive, how will you analyze what is in one or the other? But the other problem that we have to confront today, and really that goes to the heart of this issue, is simply this. The Tax Act treats differently if you sell the aggregate to if you sell the sum of the parts. That's all we are dealing with today. If you sell the sum of the parts, there is a consequence. If you sell the aggregate of the parts, there's a different consequence. Now, you don't have to worry about whether that makes sense or it doesn't make sense, because you're not here for that purpose today. You just simply have to understand that selling the whole is different from selling the aggregate of the parts in the individual components. To the business person, this makes no sense at all. Business person says, there's a company, I want to buy it. And you say immediately, hold it. What do you want to buy? Do you want to buy the company, or do you want to buy the assets? If you buy the company, you buy the shares. If you buy the assets, you buy the individual component parts. The business person says, I want it all. You say, yeah, but that's true from a business point of view, you want it all. But from a legal point of view, as the corporate commercial people will tell you today, and from a tax point of view, as I will tell you today, the consequences are very different, and you have to understand what they are. So the person says, well, tell me what are the consequences. Well, if you look at page 88 of the material first, you'll see a broad overview of what the consequences are. And I've set out basically three alternatives here, and could set out any other number, but three will suffice for today. Here we've taken a very simple situation where you have a property that has a cost of $100. Now, the zeros don't matter in this. If you want to think in big terms, make that millions, make it billions. If you want to think in medium terms, just put on 3 or 4 zeros. If you want to think in small terms, leave it where it is. You've got a $100 cost of a property, and the value of the property is $1,000. So you got a $900 gain. Now, the gain is inside the business, obviously. The shares are merely representative of what the business is worth. It's a reflection of what the business is worth. If you sell the shares, you will trigger a $900 gain. That's easy enough to see. And the consequences of all that, which is really fairly straightforward in that column, is that you will end up with $663 in your pocket at the end of the day. Now, these rates can vary slightly depending upon what happens, but they are reasonably approximate to today's consequences. We've assumed an individual tax rate of 50%. It can go down a point or two depending upon what happens in the promised election give-outs, handouts, but they won't change very much, because the reality is those rates that are coming down and have come down have not come down for anybody, not come down significantly for anybody under earning over $65,000. Because when they dropped the rates, they simply increased the surtax rates for those at $65,000. So the difference between those two groups is minimal. Most people don't realize this, and the Toronto Star certainly hasn't caught on to it. But I mean, that is, of course, the art of being a politician, and it's very brilliant. I don't say it with any, I'm not pejorative about it. I think the art of being a politician is, in a sense, to fleece your constituents without them knowing it. And I was talking to a minister the other day, won't identify, but he said to me, I want you to think about this. And he said, I want you to approach it from the view of fairness. I said, Minister, I've been in this game for 30 years. I've never heard anybody say, I want an unfair tax system. The only point of difference that we have, if we have any, is what is fair. Everybody wants a fair system. And a fair system is one that puts more in my pocket than yours. That's basically what a fair system is. But Here, you're left with $663. Now, if you move over to the middle column, I'm assuming here that you sell assets. That is, you sell the individual components inside. Of course, when you sell shares, you sell the entity. That means you sell the assets and the liabilities and the contingent liabilities and the hidden liabilities and the potential claims. You sell in toto the entire entity. When you sell assets, of course, you only sell the left-hand side, so to speak, of the balance sheet that I've given you, and you have to get permission and authorizations, etc., for the right-hand side of the balance sheet, the liabilities, your debts that you owe to other people. The corporate commercial people will tell you what to do with that, because those obligations are backed by the assets on the left-hand side, and if you're getting rid of the assets, the creditor to whom you owe the money is exposed and has to be protected. So I'm assuming, for present purposes, just to keep it simple and comparative in that middle column, that every asset that you sell, everything that you sell everything except cash, receivables, inventory, fixed assets, furniture, plant, equipment, domain name, goodwill, whatever you've got on the left-hand side of those financial statements that you've got, whatever you have there, you sell all of that. I'm assuming, just for comparative purposes to start off with, that you trigger a capital gain. In fact, you won't, but let's assume that you do. That means only 75% of the gain will, in fact, be taxable, as opposed to if it was an income gain, a regular gain, 100% would be taxable. So that's the first break that you get, and it's an enormous break. Most of the tax policy debate that occurs around that very key issue. How much do you pay for capital gains? When we say everybody's moving to the United States in the high-tech sector, what do we mean? Well, what's pulling them there, apart from opportunity and research and funds and so on and so forth? I mean, what's pulling them there on the tax side? Well, on the tax side, what's pulling them there is that if you get a stock option and you make a capital gain, you will end up paying a tax of 20% at the time that you sell the property. Whereas if you made the same gain here in Canada, you would end up paying tax at a rate of, about 40 some percent, and that's a very significant difference. That's the difference between the tax rate, their 20% rate, and our 40 some percent rate. But assuming the best case scenario, you see what happens. It goes to the corporation. The corporation triggers, as I say, a capital gain of $900, the whole amount. It then has to pay certain taxes. It pays its regular tax, and it pays a special tax on investment income. And then some of those taxes are refundable back to the corporation when it pays a dividend, and they are subject to very detailed and technical rules as to how much is refundable out of the corporation and so on and so forth. For your purposes, all you need to know is that the amount refundable is the lesser of two amounts, 1/3 of the actual dividend paid and 26 2/3% of the investment income, in this case the capital gain. It's a mind-numbing exercise, but these days that's not a huge problem. You go down, you buy some software for $50, you put it onto your machine, you enter the numbers, and it's all done for you. Monkey see, monkey do. There's nothing to it in the calculation, as long as you put the numbers into the right box. If you put it in the wrong box, you'll get the wrong answer and you'll never know the difference. So from a lawyer's point of view, it's not the computation that's difficult. The computer does that in nanoseconds and does it faster and faster every year. It's simply knowing what information to put in which box. But at the end of the day, if you put it into all the various boxes, you will end up with $831 available for distribution. That's the tax that you pay and the refund that you get. You'll end up with $831. Now, The first difference is, in that scenario, you have now to flow it out of the corporation to the shareholder. So in this scenario here, you flow it out as opposed to the shareholder who owns the corporation. In the first scenario, you paid the shareholder directly. In this scenario, the corporation sells the assets, and now you get it out from there to the shareholder's hands. And of course, since you have two taxpayers, one is the corporation here, and the other is the person, the individual shareholder, you've got a tax here, and you've got a tax here. So every time you create an entity, you in fact multiply the tax payable. And the trick is to try and devise a system that you do not have multiple taxation or double taxation, which is a very difficult problem, both in domestic and international tax. So that if you have a corporation here, let's say a Canadian-controlled private corporation, which has an operating company, which has a foreign subsidiary, which in turn has another foreign subsidiary, which in turn has another foreign affiliate, basically you've created 6 levels of taxation. And the trick is to ensure, the systemic trick from the structural point of view is to ensure that you do not pay 6 different taxes, 6 levels, and from the taxpayer's point of view, to minimize the amount of double taxation. So what we've got here is a flow through from the corporation to the shareholder, and that we've assumed is a basic tax of about 34% on the dividend, which is given to you in your assumptions, which is down from 50% on the individual. So we treat dividends going through a corporation a little bit more generously, but nevertheless there is an element of double taxation built into the system. And that's problematical. It's a huge issue, and it results in double taxation to some extent. But at the end of the day, if you go down that route, you'll come out and you will have $625 in your pocket as opposed to $663. That's a difference of 6%. Now, if 6% doesn't matter to you, then you can go either way. You don't care. But 6% to an average investor is an inordinate amount of money. We kill for half a percentage increase in the yield that we can get on an investment asset. So 6% is just a huge difference. But to those who don't care about money, say, look, go either way. There is one additional difference between the two, and that is the fact that there is a difference between the tax payable by the shareholder, which is $338, and the timing of the tax payable by the corporation, because there are 2 levels of tax. First, the corporation pays the tax, and then the shareholder pays the tax, which means that by not paying it out of the corporation to the shareholder, you can delay the payment of the tax. And that delay, in this particular example, is $11. That delay is on $11. That's a timing difference, and the value of that delay depends upon the interest rate. And the higher the interest rate and the longer the delay, the more valuable that deferral becomes. So we, in fact, consider that to be a valuable asset. So there are 2 differences, as you can see. One is in the absolute dollars that you will end up with $625 as opposed to $663, and 2, there's an $11 delay. Now you say at this stage of the game, who really cares about all this? Well, the client cares, because at the end of the day, the client is selling this business for the maximum yield that the client can get. And the purchaser has to be concerned of paying the best price that the purchaser can get the deal for. Now, if you would just move over to the last column on the right-hand side, here I change the assumptions just a little bit and make it a little bit more realistic. I say, let us assume that you will have 50% capital gains from your assets, and we'll be coming to that in a moment, which ones will do what, and 50% income gains. That is, looking in the left-hand side, the balance sheet, your financial statements that I've given you, some of those assets will trigger income gains, and some of those assets will trigger capital gains, and some of those assets will trigger another different type of gain in between those two, and so on. So there are different types of gains depending on the asset. And I'm making a simple assumption here and saying, let's assume it's 50-50. Half ordinary income and half capital gains. Notice how simple the Income Tax Act would be if we simply abolished the distinction between income gains and capital gains and went to a flat tax on all types of gains. You'd get rid of all of these rules. Or would you? And do you want that to happen? If you do want that to happen, write to your member of parliament and say, we want to tax all gains at one rate. And they'll say, sure, we'll do that for you. We'll tax it at the higher rate. That's inevitably what happens. Nobody ever comes down to the lower rate. Inevitably, you step up to the higher rate. But assuming 50-50, now the consequences change again. And the basic, it's an amalgam of columns 1 and 2. Basically what happens is that the capital gain is taxable at a lower effective rate because only 75% of it, namely $450, is now a capital gain, and the other $450 is an ordinary income gain and is taxed at the higher rate. And so you work through the numbers, and now you're left with only $509 in your pocket. So the first observation is that going from column 1 to column 3, you're worsening your position as you go along that continuum and spectrum. And from that, we can generalize one observation and say, it appears to us that the higher the income gain component, the lower the amount left in the taxpayer's pocket. We've gone from 100% capital gain to 50%. If you move from 50% to 25%, that number would drop. From 25% to 10%, it would drop, and so on. So that is a continuum. And that is going to affect your decision-making and your structuring of the overall transaction. The second point that you make here, as you see here, is, of course, now that the percentage difference is 23% in your yield. And if you were not interested in 6%, I suspect you'll be much more interested, in your client will be much more interested in 23% extra being taken out of the pocket. And the third point is, you see now that the deferral issue is now at $39. And the value of a deferral is a function, basically, of three things, three factors. The dollar amount, which in this case is $39, the rate at which you calculate it, which you don't know at any, which you know at any specific point in time, but you don't know, you can't generalize, but let's say is 8% at market rates, and the time, how long you keep it in. Any time from 1 to infinity, the longer the time, the greater the value of the deferral. So, at the end of the day, that is the scene that you are playing to. That is the purpose of the entire detail of the structuring of the transaction. If you can digest just this one page on page 88 and understand everything on that, then you understand the purchase and sale of a business and the tax consequences associated with it. After that, everything else is simply detail. You put your mind to it, you find the requisite section of the act, you read it 3 or 4 or 5, 6 times till you understand it, you read it word by word, not a speed reading exercise, and you will digest the technical information. That's all it is. The statute is not easy to read. Nobody has said it was easy to read, but it is not impossible to digest. The complexity of the statute lies not in understanding it and reading it. The complexity of the statute and the difficulty of living with it is when you stand up before a judge you have to explain the concept in an understandable manner. There lies the difficulty. You're explaining it to a non-technical person, and you're taking a paragraph that extends over 4 pages with 1 period in it, and you're explaining that concept to this non-technical person and saying, my lord, this is what it means, and this is how it should be interpreted. That is the difficult part of the exercise. Now, let's go back now and see how some of these rules are actually implemented and affect our structuring of the transaction from a tax point of view, and what you'll be talking to the commercial lawyer, the corporate lawyer, and saying, if you do it this way, this will happen, and if you do it this way, this is what will happen. And they'll be talking with you, and you'll be talking with them, and you'll be trying, depending upon whether you're the vendor or the purchaser. Obviously, if you're the vendor, you want to be in column 1. You want to sell shares, generally speaking. But if you sell assets, your yield will go down. The problem is that the purchaser almost invariably will prefer to buy assets. Almost invariably. And there are 2 major reasons for that. Reason number 1 is a commercial reason. You don't want to buy somebody else's hidden liabilities. It's as simple as that. You go and buy the enterprise, you buy the liabilities. You can see some liabilities. They're on the right-hand side of your balance sheet, or on your balance sheet at the bottom end, liabilities, the second half of the page. You can see some of those, but those are only your disclosed liabilities. And those are liabilities that have been disclosed at those values. The problem is your undisclosed liabilities, the ones you know nothing about, and the ones that will get up one morning and bite you. Those are the ones that the purchaser doesn't want. So a purchaser will almost invariably want assets, and the vendor will almost invariably prefer shares, which means, since there's a difference in the yield to the vendor between $663 and $509, they're going to have to come to an accommodation. They're going to have to come to an accommodation on the price that is going to benefit both of those parties, assuming that they have equal bargaining power. They're going to make an accommodation. The other aspect to the vendor of selling shares is that we have assumed that the vendor is paying tax here of $338 in column 1. In fact, the vendor's tax may be 0. The vendor's tax may be 0 because if you're talking about a small transaction, up to $500,000 of capital gains, and the person hasn't utilized what we call the exemption for qualified small business shares, then the entire gain becomes tax exempt. So the vendor now is looking at $1,000 in proceeds if the gain is exempt versus $509 in assets if it is not. And again, there's a give and take. The vendor may say, all right, I'm willing to accept a lower price if this transaction goes through in shares, because I will keep more of it. But if it's going through in assets and I'm going to get hit with 2 levels of taxes, then I want a different price. And that's a perfectly legitimate position for the vendor to take. The second difference is, and it'll make a much greater difference now to the purchaser, if the purchaser buys assets, the purchaser buys the assets generally at their fair market value and not at their cost as shown on the financial statements, which are historical cost. Which means, from the purchaser's point of view, from a tax perspective, and tax perspective only, that the purchaser can write off more at the higher cost. For example, suppose you have a building. You constructed the building for $100,000, and the building is now today worth $2 million. If you buy shares, you buy it at $100,000 because it comes over as is. If you buy assets, you buy it at $2 million, which means you can write off $2 million for tax purposes, as opposed to you're stuck with $100,000 if you go the other route. That increased write-off of $1.9 million is very valuable to the purchaser from a tax perspective. And so the purchaser will usually like to go with an asset acquisition for tax reasons over and above the fact that the purchaser is not buying hidden liabilities. Is not buying hidden liabilities. I mean, think about it. How much would you be willing to pay for Philip Morris today? Well, an enormous amount, since they are a very lucrative company. But everybody knows that everybody and their second cousin is suing Philip Morris. And the contingencies, and every government has gotten on the act in the United States and now in Canada, and there isn't anybody left who's not going to sue Philip Morris. If you trip down the street, you say, well, it was Philip Morris's fault. There are huge contingencies hiding in Philip Morris. And those contingencies are unknown at this time because every person who develops lung cancer between now and the next 30 years, people who haven't even been born yet, are potential plaintiffs against Philip Morris. Some people who haven't even used their products will jump in, simply saying because their ad was so attractive, they were induced to smoke. They liked the Marlboro ad, but they smoked Players cigarettes. And so the contingencies are limitless, and that's what the purchaser wants to avoid. Now let's come down to a few of these individual assets, and I'll take you into a little greater level of detail, but not into that mind-numbing level of detail. You have only about another 15 minutes that you need to listen to me, and then you'll get back onto your more exciting topics of things like covenants and indemnities and other subjects that are going to be spoken about later on today. Let me touch upon a few of the major assets that every business owns and touch upon one of the assets that is characteristic to this particular type of business. You'll see that the assets are classified on the top of the page into various little groupings. Cash is, of course, cash, and there's nothing much to be said about that. Marketable securities, again, very little to say about that. Marketable securities in this particular case are approximately equal to their market value. Their cost and market value are approximately the same, but obviously any person who's buying anything is going to have to pay fair market value and not book value. And by the way, even if you are dealing non-arm's length, that rule applies. That is, I've said two of the issues that we are concerned with is what do you buy and how much do you pay. There is a third issue that is important in certain cases, and that is who is the purchaser. That can become a very important issue in certain cases, unlikely in this scenario, but it could arise in many other scenarios. Who is the purchaser? Because if the purchaser is a tax-exempt entity, then you've got very different considerations between, because if you're dealing with a taxable person and a tax-exempt entity, you do not have the same tension, the tax tension, that you would have in an ordinary commercial transaction. Why? Well, for example, suppose your purchaser is a pension fund, or your purchaser is a labor union, or your purchaser is some tax-exempt trust. then you don't have the same tension, because one of your underlying reasons for buying assets has now disappeared. I said one of the underlying reasons for buying assets is you get a higher write-off. A higher write-off on the building of $2 million rather than on the cost of $100,000. But if it is a tax-exempt institution that is purchasing, they're not interested in write-offs because they don't pay tax. So they're not going to bargain as stringently with you on the vendor side if they're tax-exempt, because it doesn't make any difference to them. And so you could end up cooking your figures quite nicely in your agreement of purchase and sale as to the value that you attach to the particular assets, because one party is not interested and the other party is very interested. And therefore the minister retains the power to come in at a later time and reallocate values between the two parties. So your agreement may be binding upon the purchaser and the vendor, is not binding upon the minister. The minister is a third party, is not a party to your agreement, and has no interest in your agreement whatsoever if you have cooked the books. By that I mean if you haven't bargained at economic values at arm's length. So the minister is an interested third party who's not a party to your transaction. So always remember that in any commercial transaction. You never bind the minister. You never bind the minister. You can use 100 pages of documents and you can have all the precedents and you can put in there whatever you want. You never bind the minister. 2, it's always a good thing to remember, if you don't pay your taxes at the corporate level, they will assess you at the personal level. So that the directors are generally personally liable and on the hook in any transaction if they do not pay the taxes. So, and the latest law is people who are not even directors but who act as directors, even if improperly appointed, are also personally liable. So those are 3 good principles to remember at the end of the day, that who at the end of the day is going to pay the bill. And as a rough rule of thumb, you will not beat the minister, ever, in any of these transactions. So you might as well accept that right at the outset and adjust for it in your arrangements. Now, let's look at some of these assets, and there are 2 or 3 that are important that I want to draw your attention to, and they will appear in just about every business. Accounts receivable, simply the debts that are owing to the business. Inventories will appear in one form or the other if you're dealing with any business that is selling a physical product. Fixed assets, land and buildings, and intangible assets, such as goodwill, and in this particular example, the domain name. Now, I said at the outset, one of the complexities of the system derives from the fact that if you sell all of something, the consequences are characterized in one way, and if you sell the individual parts, they're characterized in another way. And that's true of both inventories and receivables. What are receivables? Receivables are basically, if you sell something on credit, and they're not paid for, obviously on credit, you have an amount payable to you. So if you've sold $400,000 on credit to an account, you've taken that $400,000 into revenue through sales, and you haven't been paid the cash, you will have an amount receivable of $400,000. Well, that's simple enough. So that's a revenue transaction. Revenue meaning sales revenue. It goes into income and is taxed as income. And therefore, you would think that if you sold this in a business, that should be treated in the same way as a revenue transaction. after all, it generated from a revenue item, and all you're doing is one person stepping into the shoes of the other. That is, A sold to B, and then B sold to C. Shouldn't C step into the same shoes as B? And to B, it was $400,000 of revenue. To C, it should be exactly the same amount. Not so. The Act says, or the law says, it's not the Act that actually says it, it's the common law rule, is that if you sell all of the receivables, that becomes a capital transaction and not an income transaction. And therefore, then we have to consider what the consequences are of that. And secondly, the other effect is, it is extremely unlikely that you will collect all of your receivables. Very few businesses have a 100% collection rate. And so when you're buying that $400,000, or in our example here, accounts receivable of $682,000, one of the questions that you have to ask is, sure, on the books it shows up as $400,000 or $682,000, and these receivables I'll buy and they'll be assigned to me, but how much am I going to collect at the end of the day? Remember, what you're buying is a promise to pay, and if the person doesn't pay, then you are going to get stuck as the new purchaser of the assets with that loss. Now, your protections and indemnities and so on and so forth that you take from the purchaser as part of your purchase and sale agreement will give you a cause of action and a right of recovery and so on and so forth against the person who sold it to you. But as I said, it does not bind the minister. And in order to be able to claim deductions and reserves and so on and so forth, basically we proceed by way of an election under Section 22 of the Act. Okay, now, I can see you're tiring already about this. The mention of a particular section has caused you to lose interest immediately in this whole thing, because you want to approach the subject without reference to the statute. And I want to approach it without reference to the statute too, but I cannot. At page 23, I've given you the rules, and I've given you a numerical example at page 25 and 27 and so on, and someday when you've got nothing better to do, you can read those. It's all there. But you have to remember that as soon as you see the word receivables, all you need to think about first are, will I collect all, and what happens if I don't collect all? And then you go to Section 22 and you see what the rules tell you. Inventories, similar problem. If you sell the whole, it becomes a capital transaction. The next category of assets, and this is routine again in every transaction, and you have to be careful about. Every purchase and sale agreement requires an allocation of the purchase price to specific assets. You cannot have a purchase and sale agreement that is simply a global purchase price and say, I buy all the assets on your balance sheet at $1 million. You have to list every single asset and assign a price to that asset. You should do it for corporate purposes, and you must do it for tax purposes. And if you don't, you'll be sued, and that'll cost LPIC money, and we don't want that to happen. So please remember that. Allocation is key. You must allocate to the assets. Why? If you look at those assets at line items 8, you will see that the corporation has different assets. It's got buildings, and it's got something called accumulated depreciation. It's got equipment, and it's got accumulated depreciation, and then it's got land. So there are three different categories of assets. And what happens when you sell these assets? First of all, you'll sell them at fair market value. Obviously, nobody sells their assets at book value. Why would you sell your assets at book value? You're selling in a commercial transaction, you're going to sell at fair market value. So that one of three things is going to happen. Assuming you have a cost to those numbers, and of course you've got a cost, the cost is given to you under each of those items. Each of those items has a cost. Those are historical costs. It says fixed assets at cost, building, $1,722,000. One of three things will happen in the sale, and only one of three things can happen in the sale. You will sell it at exactly an amount equal to its cost. You will sell it at an amount below its cost or depreciated value, or you will sell it at an amount higher. And each of those will have a consequence. Now, you will see attached to those assets something called accumulated depreciation. I'm going to assume, just to keep it simple for today's purposes, that that accumulated depreciation is exactly equal to the tax depreciation. That is, those two numbers are identical. In fact, they may or may not be identical, but let's keep it simple. That means that the depreciated value is down here. The cost is there. The depreciated value, or what we technically refer to as the undepreciated capital cost of the asset, is down there. And when you sell something, and you'll probably sell up here in the case of a building, the difference between these two numbers is going to trigger consequences. What consequences will it trigger? Well, it'll trigger two consequences. The difference between here and here will trigger a gain that will be taxable as ordinary income. That means fully taxable. And the difference between here and here will trigger a gain that is taxable as a capital gain. That means only 75% taxable. And that is why when you go back to page 88, you see the difference between columns 2 and 3, and the exact difference between columns 2 and 3 will depend upon where these numbers come out. And therefore the consequences will vary with the numbers that come out. Which means from a transactional point of view, going back to the statement of our Boston Brahmin lawyer, your job is to make sure that the price allocated to this is the most advantageous to your client. And what does that mean? Well, generally, you will want to maximize this component and minimize this component. Why? Because that's 100% taxable, and you will want to maximize that because that's 75% taxable. And so in the allocation, your job for your client is to minimize, depending upon whether you're acting for the purchaser or the vendor, one amount and maximize the other. If your clients, if the person on the other side of the transaction is well represented, they will be doing exactly the opposite. They will be doing exactly the opposite. At the end of the day, it's a question of who knows more and who's the better negotiator. If you simply take the point of view, well, a dollar is a dollar, a buck is a buck, I don't care where you assign it in the agreement, then I'd love to have you on the other side of the table, because I would allocate everything to land and a minimal amount to the building. And the land here is worth $959,000, and the depreciated value of the depreciable assets is about $3.4 million. I'll sell you everything for $6 million. All land and nothing for the buildings. And why? Because if I can do that, I will say I'm getting a capital gain. And I'm up here on the 75% route. And I will avoid all of this. All of this. In fact, I'd rather, allocate somewhere down there and create a loss on the buildings, which I can then use and put everything to the land. From the purchaser's perspective, that's terrible, because the purchaser will end up with what? An asset, $6 million, land, non-depreciable. It's a non-depreciable asset. And the cost allocated to the buildings will be, in this extreme example, 0. So the purchaser will depreciate 0. And land's a non-depreciable asset. So the purchaser is caught in a terrible situation in that scenario. Unless you're selling to the church. Because it doesn't matter. Or a labor union. Or a pension fund. Because they're not going to depreciate anyway. So you can say to them, look, normally I'd sell this property for $6.5 million. But since you're the church and I'm religiously oriented, I'll sell it to you for $6. I'll give you a break of $500,000, provided we allocate everything to land. And the bishop says that's fine. It's a done deal. You write up the agreement, you sign it, minister comes in and looks at it, he says, hold it. I'm not buying into all this nonsense, and reallocates the amount. All right, you can begin now to start wakening up, because we'll be through in 3 minutes, so come out of your sleep slowly. Do not startle yourself. The last asset I want to talk about is domain names. It's an intangible asset, and it is unique to this type of business. Goodwill is another intangible asset that has special rules attached to goodwill, and they're fully described in the materials. But domain names is a relatively new issue. First of all, we don't know what a domain name is. At least I don't know what a domain name is. Some of the people speaking today may well know what a domain name is. Is it a trademark? What is it? What kind of an asset is it? What is a domain name? Is it something you can register and protect? That's a corporate commercial issue. From my perspective, the issue is, what can you do with a domain name? In this particular case, you've got a domain name that has a value of $50,000. And presumably, the purchaser is going to buy this domain name. Domain names sell on the marketplace. You can go onto the internet any day, and there's a marketplace, and there's an auction price, and you can put in a bid on many domain names. The list is there, and it's updated every single day. For example, 800sex.com is selling at the present time for about $80,000. Some very far-sighted person obviously knew that that is where the market is, and has registered that domain name under the 800 name. And so you can go. It is interesting that, apart from the highly cherished domain names like Nike and Coca-Cola and Pepsi and IBM and Hewlett-Packard and all of those things, the other names that command the greatest price have all got something to do with sex, which tells you something about something. I'm not sure what, but it has a commercial value, and as I said, there's no transaction in this world that you can engage in without it triggering some tax consequences. And in this particular case, you have to answer the question, what is the domain name? Can I write it off immediately if I acquire it? That is, I pay $50,000 or $100,000 for it. Can I write it off in the year I acquire it? That's a possibility if you argue that domain names and the technology is changing so rapidly that the useful life of the name is very short. If you argue that the life of the name is infinite and it'll stay with you forever, then it becomes an asset like land and you cannot write it off. Or or if you consider it to be something in the intermediate category, what we call an eligible capital expenditure, which is a tax category. It doesn't exist in commercial law. Then you can write off 75% of the name at 7% a year. Why? Well, because the Act has set that out as a formula. It doesn't make any sense, but it's 75% at 7% a year. So there are three possibilities. I'll stop at that. I mean, there are many more interesting and exciting possibilities that one might consider. For example, you might consider an offshore corporation that has the domain name, in which you position the domain name in a jurisdiction that has more generous rules, and so on, writing off and so on. But we are really talking about purchase and sale of a business in a domestic context, and I won't take you down that other route, which obviously in this business of high technology and cyberspace type industries is a very realistic consideration. That is, when we speak about bricks and mortar commerce, we really speak about bricks, buildings located in a particular jurisdiction. When we speak about electronic commerce and technology, we are not locked into a place. We can locate our businesses and our corporations and our entities anywhere, and there are many great advantages to locating your businesses offshore. In fact, just a few months ago, the president of Intel Corporation, testifying before the U.S. Senate committee, said that had he known when he created Intel and set up Intel as to how successful it would be and the money it would make, he would never have located Intel in the United States. And that is certainly true for any business. The first piece of advice we give any person coming into Canada to locate business is why? Why would you want to locate a business in Canada? It doesn't make any sense. It makes no economic sense. You'll pay a much higher tax rate than if you locate it elsewhere, 20 to 30 percentage points higher. And so for the person just coming in with a high technology position, we would not locate the business in Canada. We would probably locate it in a place like Ireland, which is exactly where Intel and Microsoft are, because the tax rate is 10%. Now you say, this person is terribly, terribly unpatriotic. Why would he not pay? That is me. I'm unpatriotic. You are patriotic. Because I'm trying to save my client from paying 45% down to 10%. And you're saying, why? And I'm saying, why not? Wouldn't you rather save 35 percentage points on your tax by locating your business in Ireland than locating it in Canada? Now you say, but they don't have health care. But that's not true. They do. They do have health care. And in this technology, in this business, you can locate anywhere. Anyway, I only say that to you to not to distract you from this problem that you're dealing with, which is a conventional problem and has lots of issues, but simply to sensitize you to that other issue, that as technology moves along and it is rapidly changing, and as industry goes, as we think from bricks and mortar to digital technologies, we also have to adjust our thinking as to how and where we locate our transactions. The single most intriguing and intellectually stimulating and most demanding issue of the next 10 years is, does a server, that is a server, computer server that serves a computer, constitute a permanent establishment for tax purposes? That is the single most intriguing, difficult, and complex issue, and that has not been answered. And it will have to be answered as we move along in that technology. All right, you're awake now. Thank you for your attention. It's good to see you, and I hope you enjoy the rest of the day. And now, I hope this was not too tedious for you. Thank you.
Thank you, Professor Krishna. Professor Krishna always has the ability to take a dry subject and make it entertaining, and he also has that special ability to take a complex subject and make it simple enough to at least grasp the essentials of and know where the problem areas are. We're going to turn our attention now away from tax and back to the commercial side of the transaction, and we're going to be talking about due diligence and closing conditions. Due diligence was something, you know, when I remember back when I was an articling student, when an associate or a junior partner would ask me to act on a transaction and say wanted me to get involved in the due diligence, it always seemed that that was a task being delegated down to the lowest level you could find somebody to work on the deal. And I think you know, we don't give it enough attention, and in really what we need to do is I think elevate due diligence to a much higher level, because due diligence means understanding the business that we're going to be buying. And if we do anything as commercial lawyers, if we provide any service to our clients, it's helping them to understand the business they're buying, and more particularly, if we're going to be drafting an agreement of purchase and sale and negotiating that agreement, we have to understand the business we're buying as well as we can. So speaking to us this morning on that topic is Curtis Cusinato and Rob Wilkes. Rob spoke to us earlier. Curtis is a lawyer, a partner at Stikeman Elliott. He practices, as I do, in the mergers and acquisitions area. He also does securities law. Curtis has legal degrees both from a Canadian university and a JD from the University of Detroit, so he's called to the bar in both the US and Canada. He's also spent some time at Stikeman's Australia office, which sounded like a nice way to spend a year to me, and I gather his wife is still quite annoyed with him for dragging her back to Canada. But Curtis will speak to us on the commercial aspects of due diligence and closing conditions, and Rob will assist on talking about the special aspects related to intellectual property and electronic commerce.
Can you hear me up back there? Thanks, Greg, very much. I should say thanks, mate, as they'd say in Australia. I don't know if I'm worthy of Professor Krishna's reference to due diligence being one of the more exciting topics. I was thinking of calling this topic duediligence.com, maybe get people's attention. But certainly, I think most practitioners in the room would agree, although it's not the sexiest topic on the agenda this morning, certainly one of the most important. You should have received as part of your materials 2 documents. One is a general due diligence checklist. I don't intend to walk through it. What I'd like to do is provide some more general comments on the due diligence front. There's also an annotated conditions of closing, which I'll deal with more in the latter part of this presentation. The format for this morning is I'll deal with the general due diligence issues, which I'll call it the widget side, and then Rob Wilkes, who spoke this morning, he'll deal with more of the IT/IP type issues, which we'll call that the website side of the equation, and then I'll provide some additional thoughts on closing conditions. On the due diligence side, I'm going to deal with 3 areas. What exactly is due diligence, and when people say due diligence, what do they mean? The second area I'd like to do is just provide some practice tips and some recommendations on due diligence investigations, how to deal with your clients on that area. And the third area, I'd just like to provide some views as to an approach of due diligence in view of the case study. You often hear when people talk about due diligence, we have to do due diligence. What does that mean? Well, I think most practitioners have a good sense of what it is. Clients know it's a good thing, they just don't know what it is. And that confusion is somewhat understandable given the use of the term in 2 main contexts. One is the context of a U.S. public offering, the other one is in the context of a private acquisition. And I'll suggest to you that in the context of a private acquisition, you'll hear due diligence involved in some kind of debt financing or in a joint venture arrangement. And I think for the purposes of this presentation, we can put all of those due diligence investigations into the one category of private acquisitions. Now, on the public offering side, effectively, due diligence is a concept that comes from the U.S. securities legislation. Effectively, in any type of offering where underwriters are required to do a certain level of due diligence investigation in order to ensure that there isn't any misrepresentations in the prospectus. In the event there is a claim, the underwriters or the directors for the issuer will have to basically satisfy the test that they conducted such reasonable investigation as provided reasonable grounds for belief that there was no misrepresentation. And this is classically known as the due diligence defense. This is a standard of law that is basically codified in U.S. legislation and in Canada. And I suggest to you that the standard has been added to through case law, both in Canada and the U.S. Now, what we're talking about today is clearly different in terms of purpose and scope. We're talking about due diligence in a private acquisition context. What we've done is basically over the years imported the term from the U.S. securities arena and to a certain extent the Canadian securities arena. And although the standard's not shaped by the legal standard, it is certainly at the end of the day what our objective here is to understand what we're buying, no more, no less, basically to get a good understanding of what the business is. Now, I guess understanding what due diligence is, the next question is what level of due diligence is due. The bottom line on this, it certainly depends on what your client's desires are, what your client's expectations are. Generally, this decision is based on a number of factors. The first factor is the nature of the business. If you recall a recent transaction which a NASDAQ company basically listed on one asset, it was a domain name, bingo.com. Obviously, your level of due diligence in those scenarios are going to be a heck of a lot more restricted than, for instance, the case study here, which involves numerous elements of technology, environmental, real property issues. The size of the transaction, the amount of the purchase price, obviously if we're purchasing a corner store, the scope of the due diligence is going to be somewhat limited as well. It's just not going to be able to handle the level of due diligence, for instance, as the sale of a public company. And again, we'll have to the scope of the due diligence will be somewhat limited. Certainly, the purchaser's knowledge will affect the amount of due diligence we do. If it's a management buyout where the management is intimately familiar with the business, I will suggest to you there's not a lot you're going to find that the management doesn't already have a good understanding of. The creditworthiness of the vendor, and I guess an additional issue which would go with that would basically be the strengths of the reps and warranties. If we've got a vendor that's got a lot of money, we've got an agreement that's got full-blown reps and warranties. We know we're going to be able to collect on them if there's a breach. The level of due diligence may have an impact based on those two factors. Obviously, timing has a factor in the level of due diligence we do, and of course, the resources. Can your client afford to engage in a full-blown due diligence investigation? Now, due diligence is effectively divided into three different areas. You've got your classic documentary due diligence, and this is, I think, the area that lawyers are, by and large, more familiar with. This is where you're effectively reviewing minute books, agreements that are material in nature with suppliers, customers, record books, and other types of documentary type due diligence. There's also physical due diligence, in which we'll call that to use a coin cliche, the kick of the tires, where effectively consultants will go in, or principals of your client, to look at aspects of the business, whether it's inventory, equipment, whether they send consultants in to do any environmental audits or cleanup work, things of that nature. And there's a third element of due diligence, which you don't really see in the private acquisition context very often, and that's management interviews. Certainly common in the public arena, but certainly less common in a private acquisition context. But that's not to be said that it's not useful in certain circumstances. Now, it's important to distinguish between what's legal and business due diligence. On the legal side, clients are going to be worried in looking at some of these material agreements for certain elements. As the case study would dictate, on the transfer of his shares, we'd be looking at provisions such as changing controls, whether there's any preemptive rights triggered, rights of first refusal, what are the termination provisions looking like, the indemnity provisions, and we'll hear from Greg on those later. These are the type of elements that we'll look at legal due diligence. Obviously, on the business side, which I'll suggest to you is perhaps more important because it's driving the deal, does it make economic sense? Are the financial ratios there to buy this? Your client will probably look at some integration issues. Environmental consultants may do phase 1, phase 2 audits. Do we have insurance consultants, etc.? So I think it's important to distinguish between the two, and I'll talk a little bit about that further. I guess one of the issues is, when do we conduct due diligence vis-a-vis the agreement? There is no rule. Certainly, due diligence can happen before the agreement, it can happen while you're negotiating the agreement, it can happen after the agreement. Bottom line is the timing of the due diligence will have certainly a reflection on the nature of the conditions of closing, and we'll talk a little bit about that further later. So at the end of the day, what is the result of due diligence? Certainly, it's a good method of risk avoidance for the purchaser. It will likely have an impact on price, may have an impact in adjusting the price. But at the end of the day, what's important in the due diligence exercise is that you take what you find in terms of material information and make sure it gets reflected in the purchase agreement. I see more transactions in which people take the due diligence and are preparing their reports right up until closing. The problem is it's not ever reflected in the actual definitive purchase and sale agreement. So I think that's an important point to keep light of. I'd like to give a few practice tips in sort of handling a due diligence investigation. I think the most important thing is right up front, you got to define your scope of review with your client, and it's all about managing your client's expectations when you're conducting due diligence. The first thing that I found helpful over the last series of transactions is set out a due diligence review memorandum. Outline in that what your searches are, what kind of documents you're going to be reviewing, whether you're going to be the one retaining local or foreign counsel, setting out your fee structure to the best you can estimate. You never want to be pinned down on that. And I guess together with this due diligence memorandum, I would emphasize strongly that you discuss the issue of fees. In more transactions than not that I've been involved in, the cost of the actual due diligence has been as much as or has exceeded the actual cost of the transaction. Again, goes back to managing your client's expectations. I think the second issue that you'll find in practicing is to what degree you get specialists involved. For us in the larger firms, it's not a problem. The purchase agreement comes around the horn, and you call your environmental person, your pensions person, your tax person, and everybody provides comments on the reps and warranties or on the underlying due diligence. For some of the lawyers in the smaller firms, I would suggest to you that there is still a great deal of a role to play, even if you're not a specialist in all of these areas. The first thing you want to do is make sure your client knows, A, you're limited in resources and you're limited in your expertise. Having said that, I think that the sole practitioner or the lawyer in a smaller firm can serve a great purpose in providing at least a preliminary review, and to the extent they need to plug in a consultant for on the competition level or Investment Canada Act level, then you can do that. But they still can retain a role as the project manager or the quarterback in the deal, and certainly as appropriate you can retain consultants. So wait to see exactly what the issues are before you retain a labor lawyer or a pensions consultant without really having the issue having a great deal of material application in the transaction. The other issues that you constantly deal with on due diligence are retaining foreign and local counsel. Oftentimes, for instance, in this case, we've got a satellite office in Palo Alto, California. What are we going to do on that business? The client's going to look to you to make sure that you do everything necessary in your due diligence investigations. He'll probably already have a lawyer retained in California. If he doesn't, he'll look to you for a recommendation. First thing I recommend when you're dealing with foreign or local counsel is send off a letter to them. Number one, you want to clear any conflicts. Number two, again, you want to get their pricing. in terms of their fee structure. Sometimes you'll find, for instance, in dealing with Caribbean Council, they take a premium of the purchase price, and you come back and their bill's $100,000, and your client looks at you. You want to clear these little nuances on fees. The other thing you want to do is you don't want to give foreign or local counsel, if you're acting as the project manager of the transaction, carte blanche power to basically say, tell me everything there is to know about U.S. law or whatever jurisdiction it is. You want to maintain, again, a very narrow scope of review, what you really need them for. For instance, in this case, with the Cyberstore acquisition, I would suggest that the first thing you'd want your California counsel to do is some basic PPSA type searches, which in the U.S. is Article 9, the UCC type searches, as well as you may send them excerpts from your purchase agreement at the appropriate time on some of your employment and labor representations and warranties. The other thing is you should also be aware that in certain transactions, the vendor will try to create an auction or a bid process. Right away, the rules of due diligence in terms of a level playing field will be tilted this way in favor of the vendor, and all the rules go out the window. In some transactions, they'll send out exactly when you can review the documents, what you can review, what you can make copies of, when you can go to the washroom, when you can make copies of binders and material information, and in terms of providing timelines for the purchase agreement, whether you can comment or not. Rather than get into the whole scope of the auction or the bid process, I think you just got to be aware that you're playing under a different set of rules and certainly a different timetable. And the last thing is tying all the due diligence together. When you're doing due diligence, you got to remember that you're not doing this in a vacuum. You have to take your information, make it useful, make sure it's reflected into the purchase agreement, and part of that process is going to be providing some kind of due diligence report to your client. I would suggest that summaries of material agreements are appropriate in most cases. Some clients want it all, but I would clearly try to resist providing excessive summaries. Try to incorporate executive summaries of all of the documentation, tying in what really is material in terms of any essential issues you've identified. Chances are your client's only going to be reviewing the executive summary. And most importantly in that particular type of report is keep a list of the documents you've been reviewing and constantly update that so the client again knows what you're reviewing and what you're not. So with respect to the fact scenario, I think the first thing I would do if I was retained to do due diligence on the acquisition of Cyberstore, first thing I'd do is get the searches ordered. Get your PPSA searches ordered. Get your federal searches, your bankruptcy and Bank Act type searches. You'd want to also obtain your certificates of status so that at closing, if for whatever reason the company wasn't incorporated or in compliance or in good standing with your local jurisdiction, it's not a surprise to you at closing. You want to do the litigation searches as well. Not only your writs of seizure and sale, which would indicate an encumbrance on title, but also is there any current litigation? Now, the thing about litigation is you never really know where it is. Usually you go down to the head office or to the principal jurisdictions in which they operate. In this case, they're operating out of Brantford, so you want to send a clerk or one of your colleagues down, do the searches, and see what's on title there, or alternatively, if there's any current litigation proceedings outstanding. There's also specialty searches in terms of some of the IT searches, which Rob will probably talk about, and other matters like workman's compensation searches you should think of. The next area you want to deal with is long lead items. Because we're buying property in this particular case, you want to make sure right up front whether your client's looking for a title opinion. If he is or if she is, the first thing you want to do is you want to make sure you can get the municipal address or the legal description, or preferably both, so that you can arrange to get the proper title work done far in advance of closing. It's not something that happens in a week or two in some complex transactions. You're going to need a lot of time for that. Again, as I discussed earlier, you're going to want to retain U.S. agent counsel, preferably a California counsel, to assist you, and I think I've already alluded to some of the things I would do in that area. Of course, you want to try to do a minute book review. The problem in a minute book review is, first off, you've always got to find the minute books before you can review them, and that's always a difficult issue. But don't get too fussed if you get into the minute book and there's a lot of deficiencies in it. Certainly, with a long, proper lead time, you can do the necessary rectification resolutions and get the company back into good standing. And again, as I indicated earlier, you've got a copy of a due diligence checklist in your materials. I'd suggest to you that that's a little excessive in most acquisitions, and you want to try to tailor that down and send it over to Vendors Council at the earliest possible opportunity so that they can get an opportunity to review it and get those documents that you need. Now, if we look at just some of the material documentation you'd want to look at, certainly on the high-tech side, you're going to want to look at the software and license agreements for change and control provisions and, again, termination indemnity provisions. You're going to want to look at some of the banking and financing documentation. You're going to have to make a determination at some point whether you keep the existing financing in place or whether you take out the existing lender. On the employment side, you're going to want to look at the collective bargaining agreement. Is there any notice provisions or change and control provisions in that? And again, just generally look at all of the material documentation. One of the last things I would recommend in terms of due diligence is at the very end of it, you still have all your preliminary searches. It's a good thing to once and for all update your searches prior to closing just to make sure nothing's happened in the interim period. And I think at that point I'll stop there and I'll let Rob provide some insight on the IP and IT issues. There is a good resource. The American Bar Association puts out a manual on practice review, which is outstanding as an additional source.
Thanks, Curtis. As I mentioned earlier, there's a rather thick paper under tab 7, and that's provided by one of the partners at our firm, Sheldon Burstein, and just acknowledging that he let me do that. And I'm not going to repeat the contents of that. I'm going to try and talk a bit about some practical sort of strategies and concerns when you're looking at a technology company. I also wanted to comment on a couple of things that Vern Krishna said. I have no problem as a member of a firm that does patent work for Newbridge in saying that I know exactly what the high-tech sector is and what tax breaks it should get. Also, Vern mentioned a preference most of the time to buy assets. And this is one place where we may prefer to buy shares because we don't trigger the change of control provisions in a lot of the license agreements that these kind of companies deal with. So that may, and also we don't necessarily want to miss an asset that we might not have purchased under an asset sale. It's always a balancing act. On the comment about sex and the internet, you got to understand that the internet was built first for bombs. That was the Department of Defense, and they put the internet out there. But e-commerce was driven by sex. The pornography sites were the people that started e-commerce. They wanted your money fastest, and of course they had a great product to digitize and put on the internet. So they're way ahead of the game. If you want the people who know the best things about the law in e-commerce, they're probably people to talk to on that. And also on whether we should keep things in Canada or not. Our family's had hockey tickets for the Leafs since the 1920s, and that really doesn't make any sense either, but I like it here. Now getting to the real, what we came here to do, the first thing you got to find out is why the client wants to buy the company. Otherwise, you're just shooting in the dark on due diligence. And I talked about this a bit before, but I can't stress it enough when you're coming into the intellectual property and the IP, the IT side. The agreement of purchasing and sale can deal with all kinds of things generally, but our client probably isn't going to be too happy if with a right to sue under the agreement, when the day after closing it turns out that we didn't own the asset they thought they were buying. So that's what you want to do on due diligence. Most transactions don't allow you to do due diligence on all issues. It's even nice that the IP guy actually got to see the transaction, but nevertheless to spend all the money that it takes to look at all of the issues. So we're going to have to find out what the issues are that are of greatest importance to the client. It's possible that this website is a complete red herring. The client may have their own website and they're going to just take this thing down and forget about it. Well, let's not spend the money on looking at it then. We consider it for its liability, but we won't consider it as an asset that we're purchasing and we're going to look into too much. And that could just resolve your e-commerce issues right there. But what are we going to do if, let's say, we are going to do a full due diligence on the IP/IT side? The first thing that we're going to do in a transaction where you're talking about a computer company is we're going to get on the internet. And the first place we're going to go is the target website and the target company's website. You're going to be amazed at what is there in most cases. Especially if they're less sophisticated, they'll put even a great deal of information up there. Who their principals are, who the inventors are, where they've been before, a complete dossier of information. It's just a great place to be. One of the reasons, well, one thing you want to note before you get into that is that your client is often not the best person to talk to. And they often don't know anything about intellectual property, and they don't know anything about the intellectual property at the target website. And that's not a criticism of the client, but it's a recognition that most of the time you're talking to somebody in finance or some other area, and they don't have a clue what's going on, and they're relying on you to take care of it completely. So that brings us to the fact that you've got to get, as an IP/IT person, you have to have someone at the client that you can talk to, because otherwise you're just out there on your own making up a deal. And if you can't talk to your client to understand what's going on from their point of view with the technology, well, LPIC may want to hear from you. And that is often a difficult thing to do, is to get somebody at your client who cares enough about these issues that they want to get involved. Now, going back to that target company website, you also want to look at things like the technical support page, because you can see there what problems they've had with the product and what solutions that they've put up. You can look at the website to find out the physical locations. As Curtis was saying, we want to know the physical locations of all of these assets to see what searches we should be doing. Well, a lot of times it's right up there on the website. You don't have to go through 7 levels of people at the target company to find out this information. It's all there, and it's there before you even start talking to them about the agreement, or you're even in the meetings. And while we're on the site, of course, we want to start looking at the terms and conditions that are there to see how the company is dealing with things like limitations of liability and privacy, the jurisdiction issues that I mentioned before, and on-land transactions. You're there, you may as well take a look through it. We may even buy something to test out the process. After you've left that website, you want to go to the rest of the internet. And it's very simple. Just type in the name of the company and see what comes back. And you're going to get back things like customer complaints and returns and all kinds of comments. It's amazing what people will say on the internet. So take a look. It's free, and sometimes you'll get nothing. Sometimes you'll get garbage, and you have to decide when to stop. Sometimes you'll get gems. You also may want to try to identify the competitors of the target company, because they may be the people that hold the patents that you might be concerned about later on. And they also may give you an idea of what intellectual property is important out there. The next place you want to go, or at some point, is your own client's website. And look at that, because that may give you an idea of what's important to that client. It might give you an idea of how these guys are going to fit together when this deal is done. And also, if the client is really sophisticated on their website, then maybe we don't have to deal with the e-commerce issues. We can just say, hey, we were over at the target company website, it doesn't look very good, and we'll send it back to the client, and they can get it fixed up after they know the issues already. Now, what other kinds of searches you want to do? are things like searches for registered intellectual property. These are more standard type searches. Among other things, you want to get an idea of what kind of company you're dealing with. These are great searches because they're coming from third parties, and then when you get the information from the target company later on, you can compare the two of them, and if they're exactly the same, you get some kind of an idea of what kind of company you're dealing with. 99% of the time, the stuff you get back from the target company is garbage, and now you know that you've got a problem and you got to do a lot more due diligence and you got to be a lot more careful. We also, in doing those searches, we want to identify all the registered intellectual property so that post-closing it doesn't fall through the cracks. If it's a share transaction, it's usually not as much of an issue because if your property is registered, the correspondence will be coming to the company because the company hasn't changed. So the foreign agents will send correspondence to the company. The intellectual property offices will send correspondence to the company. If it's an asset transaction, then you really have to be careful because now you're changing possession, ownership of the asset, and now you may have to contact all of the foreign associates around the world to make sure that they're now dealing with you and not with the vendor post-closing. Now you want to, as well, I'm going to talk about searching the owners and the inventors, but you also want to search for security interests that are filed against the property. And typically these are registered in the various intellectual property offices. So you actually want to go into the patent office and the trademark office, copyright office, or online and search what you can on security interests. And those filings are typically in addition to PPSA and Bank Act type filings because patents, trademarks, and copyrights are federal and the copyright offices are there. Excuse me, the intellectual property office exists. Patents, right away, same as Curtis says for some of the other searches, we want to search against those patents and in the name of the company. And then we'll also go back to any of the inventors and any other people that we found on our due diligence and see, maybe we'll search their names and see if any patents pop up because maybe they're in the wrong person's name. And you'll want to remember that patents have two sides to them. CyberStore, they can sue on a patent, but they can also be sued on patents. So we want to consider the competitors and searching for patents in other people's names and whether we should be doing an infringement search. And most of the time you don't go that extra step in most transactions, but you should consider with the client whether they want you to do that. Trademarks, we'll search for the registered trademarks in the same way. Under the name of the company, any predecessors, under the name of the trademark itself, the Track Buddy and the Pocket Addict, the CyberStore, and any other trademarks that we might have noticed when we were going through the website. And those searches generally are pretty easy to do. They're online, and we can get that kind of information fairly quickly. We also want to know what other jurisdictions the client's concerned about because maybe we'll go outside of Canada, maybe we'll be in the US, maybe we'll be in Europe, maybe we'll be in other places. And we'll also consider going in other countries anyway just to see what people are using our trademarks in case they're going to come into Canada later on and we want a heads up on that. We'll also consider registering the trademark, the CyberStore trademark, right away. In any country that we can, and the sooner we can get it registered, the better, because it may be that if somebody else registers that first, they can take away our domain name under some of the dispute resolution policies that the domain name registers have. And we just want to search and find out who the registered holder of that domain name actually is. On copyrights, industrial designs, topographies, we can search those out, but we're probably not going to find anything because most people don't register those to the extent that they do on patents and copyrights, patents and trademarks. We also want to look for litigation on any of the patents or any of the intellectual property, and most of the time we're going to be in the federal court. So we want to search the federal court as well. We can search in the federal court not only on the defendants' plaintiffs' names, but we can search on patent numbers and trademark numbers as well, and to see if they've specifically been subject to any litigation. The big thing that you want to do is an in-person interview. You want to get out there and actually ask the questions of somebody who's been involved in the development of the intellectual property. Most of the time, you can go through and send your checklist out, you can go through and send the agreement out, you can do all kinds of different things. You'll get all the answers that you want to hear. They'll tell you everything you want to hear, but they'll be wrong. And unless you ask the questions and go right back to the beginning, where was this created, who worked on it, what company did we do that in, what contractors did we have involved, and you ask those questions directly from an individual that knows the answers, you're probably, well, you're relying on the piece of paper then at the end, the reps and warranties, and you probably don't know whether it's true. You want to consider the third-party products as and third-party hardware and software, as Curtis mentioned, and look to see, because most of the time with these companies, it's not all their intellectual properties. It's someone else's intellectual property is incorporated into the product. So you want to see what rights they have there and find all of those agreements and check out the agreements carefully to see whether they provide your client with adequate protection going forward. The other is whether they lock your client into those kind of products as well, because it may be that the target company has a deal that we don't like because our client is in the similar business, and they may have a better deal, and they want to get rid of some of these third-party products and bring in their own. Are they stuck? Can they do that? What kind of deal is involved with those third-party products? Year 2000, one paragraph, because I just don't like this issue very much. It's not very exciting. Just check into year 2000. Are they year 2000 compliant? Do they have problems? Did they get a third party to actually look through their year 2000 status, and is there a written report available? Can you take a look at it? And one thing that was specifically mentioned in the fact scenario is encryption technology. And the one thing to note there is encryption technology is heavily regulated around the world. And so you want to look into what kind of technology that is and whether it's governed by the export controls. Some countries actually have import controls as well as export controls. So depending upon where we're going to take that technology, we may have to look into that as well. And I'm hoping that that gives you some ideas of the kind of things you want to look at in due diligence for intellectual property, IT, and e-commerce type issues.
I have the luxury of being the last speaker before lunch, so I'll try to make it quick. On the conditions of closing section, again, I'll refer to the annotated conditions of closing paper that's in there. What that paper represents are some of the customary transactional type conditions that you'll have for a private acquisition. Certainly it's not an exhaustive list, but it also provides the annotation which will give you, both from the purchasers and vendors counsel's perspective, different points on how to adjust slightly what's reflected in the agreement. I think I'll just provide some general thoughts on conditions of closing and briefly talk about the fact scenario. Like the process of due diligence, the conditions of closing are also a risk avoidance technique of the purchaser. It's important, of course, as I indicated earlier, as a result of your due diligence, make sure it's reflected in the conditions of closing if you have an opportunity to conduct due diligence prior to the execution of the agreement. The actual nature of the conditions obviously will depend from industry to industry. Obviously, if you're in a highly regulated industry, a lot of the governmental consents and approvals will probably be listed in the actual conditions. If you have an opportunity to do first day with the new lips here, have an opportunity to do due diligence prior to the execution of the agreement. The other thing I would suggest to you is, depending on when you sign the agreement in the due diligence process, will really be indicative of the nature of the conditions. If you're signing the agreement at closing, you're probably going to have very few conditions, and in fact I've done transactions where we haven't even had a conditions of closing section. As soon as the ink dries, the deal's done. So again, it's going to depend on when you do due diligence and when you're able to execute your purchase agreement. I think one thing is worth saying is important to distinguish between the conditions, the reps and warranties, and the covenants. Certainly if you look at the case law, they've placed a higher importance on conditions than reps and warranties or covenants. If there's a breach of a rep or warranty, you're entitled to seek damages. You're not entitled to avoid the performance of the agreement or the obligation. In contrast, if you're going to breach a condition, you're going to have the ability not only to terminate the agreement, but also in certain limited circumstances, if there's a breach of a covenant, for instance, to seek damages. You're also going to have the right, if you want, to close and also seek damages. Whether you get those damages is obviously a function of the evidentiary burden which you're faced with. Similarly, if there is a breach of or purported breach of a condition, there's an exception to the admissibility of oral evidence. In this particular scenario, a court can admit oral evidence to look at interpreting the condition, and in fact will use it to assist in that interpretation, not to contradict it in any manner, but certainly to assist in finding the intentions of the parties. Not the same for reps and warranties and covenants. You're going to be restricted to the nature of the agreement. So just a couple of background points on that. In terms of the actual structure of the conditions of closing section, you'll note in the precedent share purchase agreement that was handed out, you've got basically two sections: conditions in favor of the purchaser and conditions in favor of the vendor. Again, if the conditions aren't met, you have the ability to terminate the agreement, amongst other remedies. A third potential subcategory in the conditions of closing is a section called mutual conditions precedent. It's in my handout. It's not in the precedent share purchase agreement because the facts just don't warrant that. Normally what you see there is, I'll call it fundamental conditions, which are basically for the benefit of both parties. For instance, if you've got a foreign purchaser coming into Canada, there may be Investment Canada Act type restrictions. If it's an industry which is not very fragmented and there's very few competitors, you may have some competition issues. Not going to get into the substantive natures of those type of consents, but keep in mind that that is a possibility for your agreement. I think it's also worth noting that if you're able to do due diligence ahead of time, you may also find certain elements out of your due diligence that are so essential to the business. For instance, last year I was involved in a transaction for an explosives company, and it became apparent that one of the major agreements was a supply agreement for ammonium nitrate, which is a substitute for nitroglycerin. Without that, you've got no explosives business. So the parties made the actual supply agreement and the consent of that particular supplier a mutual condition precedent. So it's worth bearing in mind that there's additional conditions for the benefit of both parties that can be inserted. I'll just summate with a couple of a walkthrough through the conditions in the precedent share purchase agreement. On page 7 of the precedent share purchase agreement, we've got your laundry list of issues, and I'll quickly run through them and again encourage you to look at the annotated conditions of closing for any filler. On the approval side, effectively what you've got is a very general consent and approval section. I take it in this particular situation, the purchase agreement was drafted with not a lot of due diligence. Normally what occurs is you'll sit down with the parties and identify what the required consents will be, and there'll either be a schedule to the agreement or they'll specifically be listed, as is the case with the license agreement at subpart 12, where the consent to the change in control is specifically listed. On the reps and warranties, obviously, as I said earlier, if you're signing the agreement at closing, you don't really need this condition. But if you're going to include it, keep it in mind that not all of the representations and warranties will be brought down to the closing date. And for instance, the classic example of that is the financial statements, which are prepared as a specified date, not necessarily as of the closing date. So for instance, if they're prepared at the year end or at the end of a quarter, they will be true and correct as of that time and will continue to be true on the closing date as of that particular time. It's important to get the language right. You can either include that type of language in the actual rep and warranty qualifying the date, or in the actual bring down certificate, which just marks that exclusion. And again, we've already really talked about compliance with covenants. One thing I'll mention on the covenant side is you oftentimes see the language to the effect that the parties, or in particular the vendors, will use its best efforts to, as is used in this particular precedent agreement, best efforts to obtain all consents to change in controls. The courts have looked at this term, that in the event the condition is not satisfied at closing, the courts will look at what was the conduct of the parties, and they'll effectively apply an objective standard to that best efforts situation, so that if the vendors are not undertaking any type of due diligence and there's really no effort to complete the obligation, the courts will find that in addition to being a breach of a condition, is a breach of the underlying covenant as well. So keep that in mind in terms of your drafting. A few of the other miscellaneous conditions: directors and officers at subpart 5. You'll see a general release from the directors and officers. You'll usually see this coupled with a release of the shareholders as well, which is further down in the conditions. I would suggest that perhaps you can also put the two of those together. You've also got a non-competition agreement, which occasionally you'll find in the body of the purchase agreement. Again, this is tied to the purchase price consideration vis-a-vis the shareholder. It's likely that the employment or consulting agreement also has a non-competition element into it, but that's tied to the course of the principal's employment. In this case, whether we hire the principal or not is really dependent upon the need for that particular principal. In this case, I think we've made a determination that we'd like to try to keep him off the street and lock him up with some kind of employment or consulting agreement. On Section 10 proceedings, what this provision is intended to do is, on occasion on transactions, you'll see some concurrent proceedings. I was just involved in a transaction where we did an amalgamation, a consolidation, and a continuance all concurrently with an acquisition. So it's mainly meant to ensure that all of the proceedings in connection with elements of that nature are all done concurrently for closing as well. Again, as I indicated earlier, if the parties are able to identify what the required consents are in terms of a license agreement, it should be done. Again, this is an overlap on number 12 to the general consents and approval section, number 1. But if it's essential, put it in. And other than that, you'll have to make determinations on bank debt and purchasers' funds, whether these conditions appropriately belong. One last comment on due diligence. Or in terms of financing, which is, or I guess affectionately known as the financing out or due diligence out type conditions. Obviously, as purchasers' counsel, you would like to have these particular conditions in, but as a vendor's counsel, you'll want to resist it. So for instance, if you want to make the agreement subject to due diligence, as vendor's counsel, you're really going to have no choice but to include that in. But the way you can deal with it is either A, limit the amount of due diligence to a particular aspect of due diligence, i.e. in respect of IT or IP or some element, or restrict it by time. And usually that affects a good result for both parties. I don't want to say any more than that just because I know it's lunch, and again, I encourage you to use the annotated conditions of closing as a resource. Thanks.